Price doesn't stop at random numbers. It stops violently at 1.3000, at 20,000, at 1.1050, at 100.00. These are psychological levels, invisible lines where banks, hedge funds, and retail traders all align their orders in massive clusters. Most traders treat them as nice numbers. Institutions treat them as liquidity magnets. Understanding this single truth separates consistent traders from those who keep getting stopped out for no reason. Today, you'll learn why price always respects these levels and how to trade them like the smart money. Psychological levels are price points that feel significant to human traders, primarily round numbers ending in 0.00, 0.50, 0.000, or whole numbers. Three types. Type 1, major round numbers, 1.3000 on EURUSD, 2,000 on gold, 50,000 on Bitcoin. Type 2, mid figures, 0.50 levels like 1.3050, 4550.50 on S&P 500. Type 3, whole number indices, 100 on Dow Jones, 15,000 on DAX. These create the appearance of cheap or expensive. At 1.2 on EURUSD, retail traders think, this is cheap, I'll buy. At 1.4 on GBP/USD, they think, this is expensive, I'll sell. That collective psychology creates order flow clusters. Banks deliberately place large limit orders, stop orders, and take profit orders around these levels, turning them into self-fulfilling liquidity zones.
Banks don't trade random prices. They engineer liquidity at psychological levels to fill massive positions with minimal slippage. When price approaches a round number, smart money is already positioned, waiting to either defend it or hunt the stops just beyond it. Here's the playbook. Step 1. Accumulation. Quiet buying near major round support, example 1.0800, while price consolidates. Step 2. Stop hunt. Pushing price 8 to 12 pips above a round resistance to trigger retail stops, then reversing hard.
Step 3. Distribution. Selling into strength exactly at round numbers where retail traders pile in expecting a breakout. Step 4. Order flow cluster. When multiple bank desks align orders at the same psych level, price reacts with extreme force. 82% of significant reversals at round numbers are preceded by a brief stop hunt, 5 to 15 pips beyond the level. Trading the retest after the hunt is one of the highest probability institutional setups in Forex. 3 deadly mistakes keep traders from profiting from round numbers. Mistake number 1. Trading the exact number. Price rarely stops at 1.3000 exactly. The real reaction zone is usually 10-15 pips around it. Treat levels as zones, not pins. Mistake number 2. Ignoring bank manipulation. Institutions routinely push price 5 to 10 pips beyond the round number to trigger stops, then reverse. This stop hunt is the most reliable pattern at psych levels. Mistake number 3. Trading without confluence. A lone round number is weak. The strongest setups happen when round numbers align with Fibonacci retracements, previous support/resistance, or higher time frame structure. Here's the fix. Trade the 10 to 15 pip zone around the round number. Wait for the stop hunt, false breakout, then immediate reversal. Add confluence, Fibonacci 50%, previous SR, ICT order blocks, volume profile peaks.
You're already solid on ICT. Now you add order flow as a confirmation layer, not replacement. Here's the exact 5-step strategy. Step 1. Identify the psychological level. Major round number, like 1.0800, 2,000 gold, 50,000 Bitcoin. Step 2. Wait for higher time frame confluence. Does this align with ICT order block, FVG, Fibonacci 50%, previous SR? Step 3. Watch order flow on ATOS. Look for heat map cluster, volume profile peak, delta divergence, price up, delta down, bearish reversal. Step 4. Wait for the stop hunt. Price sweeps 5 to 15 pips beyond the level, triggers retail stops, then reverses sharply.
Step 5. Enter on the retest. Place limit order at 1.0792, 8 pips inside zone. Stop loss 15 pips below. Take profit at next liquidity zone, 1 to 2 RR minimum. Example, EURUSD at 1.0800. Price sweeps to 1.0808. Stops hunted. ATAS shows delta divergence. Price made higher high, but delta made lower high. Volume profile shows POC at 1.0800. ICT order block aligns at 1.0790 to 1.0800 zone. Enter long at 1.0792. Stop at 1.0777. Target 1.0832. That's textbook institutional trading.
Let's look at real examples, not theory. Example 1, EURUSD at 1.1000. Price approaches 1.1000, major psychological level. Daily candle forms pin bar, long lower wick, small body. ATAS shows delta divergence. Price made lower low, but delta made higher low, equals bullish divergence. Price reverses 200 pips in 3 days. Example 2, gold at 2,000. Price sweeps to 2008, stop hunt. Immediate reversal down from 2,000 zone. Volume spike at 2,000 confirms institutional selling.
300 pip drop following the reversal. Example 3. Bitcoin at 50,000. Price bounces at 50,000 3 times over 2 months. Each bounce stronger, accumulating demand. Volume profile POC at 50,000. ICT order block aligns at 49,800 to 50,000 zone. Breakout above 52,000 follows. 4,000 point rally. These aren't coincidences. They're institutional order flow clusters at psychological levels.
Let's lock in the key takeaways. Key takeaway number 1. Round numbers are liquidity magnets. Banks deliberately create order clusters here. Key takeaway number 2. Trade zones, not pins. Expect reactions within 10-15 pips of the exact number. Key takeaway number 3. Always look for bank activity. Stop hunts, false breaks, rapid reversals are the signature of institutional involvement. Key takeaway number 4. Confluence is king. Combine round numbers with Fibonacci, previous SR, ICT order blocks, volume profile. Key takeaway number 5. Follow the flow. Psych levels, round numbers, bank activity, order flow cluster. This is how professionals trade these invisible lines. You do not become a profitable trader by wishing. You become profitable by fixing your habits, one psychological level at a time. If this video helped you, like the video, subscribe to the Sigma Trader, share with a trader who keeps getting stopped out for no reason. Check out my recommended brokers and prop firms. Use them only if you're serious about improving your process. Thank you for watching. I'll see you in the next video.